You're listening to the Rite Retirement Show.
The 70% of people out there listening to the show today are going to need some level of care. It doesn't necessarily mean that 70% are going to end up in a nursing home, but 70% of people will need some assistance out there. The biggest fear is running out of money for the retiree, but what we see is not enough people spend enough of their money.
Cris prides himself in what matters to you. This is the Rite Retirement Show.
Hi there, I'm Luann Fulmer, joined by two amazing and experienced advisors from WG Financial Group. That's President Cris Wallace and Graham Bauer. And they are both certified financial planners and financial advisors, both here to help you plan smarter and retire stronger. And I want to give you our phone number because if you have questions from anything we talk about today, here's what you can do. You can call for a complimentary discovery session. Call this number or text the word visit to 256-937-2010. And I'm so excited to be here with you both, Cris and Graham.
Luann, we are just jumping for joy right now. We are so excited to be here with you today.
I know you're not jumping. I don't hear anything.
Are you saying I don't have good jumping ability? What do you?
I don't hear anything, so I think you're teasing me.
That's how I jump. I played basketball. I never left the ground when I jumped.
Oh, you don't have any ups, huh? No ups.
No, or hops as the young kids call it.
Oh,
No.
hops. Okay.
Is that not what they used to call it? Is that a
Ups
They
and
used
hops.
to say
Slang
ups,
term?
but
Yeah.
Oh, it was ups.
It was ups and
And now
hops.
it's
Makes you
hops.
sound like a baby, kind of.
Well, that fits too.
Oh my gosh.
Yeah.
Well, anyway, I'm glad you're excited. Okay. I'm glad you're excited to get started.
We are. We love our intro when you say amazing advisors.
I know, but
I love it.
I'm sincere, you know.
I get so pumped up when I
Good.
listen. It's like Michael Jordan when he came out to the Alan Parsons
Yeah.
Project, Sirius, that song.
Yeah,
That's
yeah.
how I get. We just need that music playing.
We do, don't we?
And I
Yeah.
would just be like, I would be nonstop.
Be ready to do some uppies.
Yeah.
Yes.
Ups.
Some ups.
Yeah.
Ups. Well, okay. Today we're going to talk about some tough financial truths for retirement. And, we don't want to scare you. That's not our goal here. Our goal is to help prepare you, to help educate you, which is, that's what the show is all about. So let's start with Social Security, guys. We've talked about this a lot on our show over the years. According to reports, these benefits have lost about 20% of their buying power since the year 2010, and even with cost of living adjustments, okay? So why is this such a serious problem for retirees, Cris?
Well, number one, I think this is just gives validation to why a retiree should invest their money. And again, when I say that, I'm not saying, oh, you should be invested all stock or anything like that. But I am saying that part of your plan should be to have your investment structured in a fashion to outpace inflation. Because the retiree they're faced with, I think, a harder road because of how CPI is actually calculated. And the healthcare portion of that CPI calculation is not what's actually happening in reality. So healthcare is going to be one of the most expensive things that a retiree is going to deal with, but the CPI portion of it doesn't cover nearly as much as it should. So they end up falling a little bit short, and over time, they end up falling a little further and further behind, as you kind of noted there.
Now, the trust funds, we know, are running short. And if our lawmakers don't do anything to those benefits, they could face an automatic 19% cut by 2034. So, Graham, let's talk about that. How should retirees react?
Well, I would not get into a panic about that, to be honest. And if something like that was going to happen, first off, I mean, you never say never, but I don't think there's any universe where overnight, with very little warning, benefits automatically just get cut by almost 20%. At this point, with how the U.S. is, our population pyramid, like many other countries in the world, is skewing on the older side of things. So we have a lot more retired folks, a lot more elderly folks who are reliant on Social Security. We also have a lot of folks that are disabled and reliant on Social Security, or are, widows or widowers with young kids who are not retirement age, but also reliant on Social Security. So I believe, I haven't looked at the statistics recently, but Chris, it's about 25% of the U.S. population, right? 20 to 25.
It's actually 20, but
20.
you're close.
Okay.
Yeah, that's a lot. 1 in 5 people.
That's a lot.
Yeah.
1 in 5 people in the U.S.
87% of individuals 65 and older are collecting Social Security.
Wow.
Yeah, and that's a ton of people,
Yeah.
just that demographic alone.
Especially, yeah, there's a lot of us.
They call them baby boomers for a reason. There's a lot of babies that are now
Booming.
Yeah, booming, I guess, in retirement. So there's a lot of different things they can do to fix this. I think all of them are going to be a little unpopular because when you're trying to fix a budget, right, there's 2 things you can do. You can increase income and you can cut expenses. And it works basically the same way with the government. So they're going to have 2 choices. Do we cut benefits or do we increase taxes? And I would be willing to bet almost anything that the answer to that is going to be, at least for the people who are currently within 10 years or 15 years of retirement, increase taxes rather than cutting benefits on those people. Especially if you're already collecting Social Security. Generally, when the government makes a change to a program like this, they grandfather in the people who were in the old system. Federal employees know all about that with their own working career, but even outside of that, the government does tend to do that. So there's a few things they could do. One, and I think this is probably going to happen, in the next couple of years. If not, they'll wait till the last second. But the wage-based earnings cap is probably going to get massively increased or be removed altogether.
Mm-hmm.
Essentially what that is, if you're unfamiliar, is if you make above a certain amount, and that number, is it around like 185 this year?
It's just over 180.
Yeah, okay.
Yep.
It's just over 180 this year. So if you make 180,000, we'll just round. Actually, let's say you make 200,000. For the first 180, you pay in FICA, Social Security, and Medicare. And then for that last 20,000, you're only paying in Medicare. You don't pay into Social Security anymore. I really think, and so do a lot of other people, that cap will probably come off completely or be increased by a very large margin so that higher income earners end up paying in a lot more into Social Security than they are currently. And that alone would extend the life of the Social Security quote unquote trust funds for quite a while. And then I also think you're going to see some FICA tax increases. It hasn't been increased since the 90s. Prior to that, it used to increase fairly regularly.
On a regular basis.
Yeah, every
sure.
Couple years, really, maybe 3 to 5 years for a long time, and then it's kind of been frozen. So I don't think any administration, congressional body, political party, whatever, wants to be the ones to have to raise taxes, because that's probably what it's going to take. But at some point, I think the can will stop getting kicked down the road and something will be done about it. So if you were going to ask me if I think Social Security is going to be there when I go to retire, I actually think yes. I know that might be unpopular, but I actually think it will be there, in 30 plus years when I'm collecting Social Security. But I would be less confident to say that than I would be for someone who's 5 to 10 years out or, currently collecting. I think for those individuals, you should have it built into your plan and not be expecting that it will go away.
Yeah, I agree. We have a demographic problem is really what the problem is here. So the last baby boomer, assuming age 65, will kind of reach 65 in 2029. So that just means that we have less workers paying into the system. So the age and the age demographic is not helping the system at all. In 1960, there were 5 to 1 workers for every one. So there were 5 to 1 workers for every one beneficiary. And today, it's roughly 2.8 to 1. So 5.1 to every one beneficiary. And today, it's 2.8 to 1.
Wow.
And they expect it to drop to 2 to 1 in the coming years. So we have less money going into the system. So that's part of the reason the system is also going belly up. And I know there's like argument reasons, political reasons, people will say, oh, they stole from the trust funds or they took from the trust. I'm not even going to go down that rabbit hole right now. Just look at the math in general. There's just not enough money coming into Social Security because what a lot of people may or may not realize, it's kind of a pay-as-you-go system. And if we don't have enough workers getting that 6.2% out of their paycheck going into the Social Security trust funds, then we don't have enough money to fund the system. And to Graham's point, I think I'm with him. We've talked about it for years now, that I believe that the wage-based cap, which I did look that up because I couldn't recite it right there on the air when you called me, it's 184.5.
184. Okay. I thought it was right around that 185.
Yeah. So low 180s. Yeah. 184.5. You're closer than I was. So by raising that, that just means the higher income earners pay into it a lot longer. So if you're making $250,000 a year today, you notice that when you crest over that wage-based cap, your paycheck goes up by 6.2% because you're no longer putting that in there because you've hit the cap. So I'm with Graham on that for sure. I think that's got to go up. And what that'll do is that'll just have the higher income earners pay into the system longer. I mean, Medicare already assesses an additional 0.9% tax for high income earners. And not only do you pay into it no matter how much money you make, they also assess another 0.9 on top of the 1.45 that we're all paying into the system. So I'm with Graham on that. I think some tax changes and the way that Social Security kind of looks is there's probably some changes on the horizon. I'm also in agreement that, as he said, if there's kind of a grandfathering period to some degree where when they make a change, they usually kind of grandfather some, certain years or certain ages in there. And I think those that are probably about, 5 to 6 years out, you're probably going to fall in the grandfather. I'm probably just below that. I would think at 53, I think I'm just below that. But maybe I'm not, who knows? But there'll definitely be some changes, and I'll just kind of wrap it up. It's like we talked about it before, the party that's in office during the final hour is going to pass a bill, and they're going to raise their hand and say they saved Social Security, and that's just the furthest thing from the truth. It's just you had no choice. You waited till the last minute. But that's how Congress does. I mean, just think about the debt ceiling. How many times have you heard about the debt ceiling in the past 15 years?
Yep.
It's like an every year occurrence. Mm-hmm. Oh, we're about to reach the debt ceiling. And they pass a bill and they pass a bill. With so many people on Social Security, I just can't see them making a cut. And like 40%, I think is a number out there, 40% of those that are on Social Security rely on it as a main source of income. So you're talking about cutting people, 40% of people who rely on it as a main source of income, and you're talking about making a 20% cut. I don't see that happening.
Yeah. So, I mean, I think the moral of the story would be that I think if you are planning for retirement, you should be planning for Social Security to be there if you're within a reasonable period. I do understand that if you're maybe like 37 or 45, you may be a little skeptical. But at the same time, Chris, to your point, our government is the absolute kings and queens of kicking cans down the road.
Oh, man. They're great soccer players.
Yeah, exactly. So and at the end of the day, everybody, I think the change that everybody always worries about a little more is like means testing. That may come at some point too. Yeah. But again, I think it would start very, very high, and I don't even know how exactly they would calculate who to do that to. It seems like it would be a little bit more complicated to try and means test based on investable assets or total net worth, or I don't know. That just seems a little trickier to me.
They do it with IRMA.
They do it with IRMA, but that's based on income, It is. But if you think about like IRMA too, Graham, IRMA comes out of your Social Security. Yeah.
So it's almost like a Social Security penalty in a way, because that's the way you feel it, right?
It's like an extra tax on your, that's what I usually tell people. It's kind of just an extra tax on your Social Security. It's not fun to pay, but.
Yeah. And speaking of that, like think about, I think we talked about this a couple of weeks ago. When I teach live events, I have like a little spiderweb that I show in my little presentation that I hand sketch. It looks pretty decent, actually. I didn't know I could draw a spiderweb so decently. But anyway, inside the marginal rates, the 10, 12, 22, 24, 32, 35, 37, inside of all of those, you have the NIT brackets, the net investment income tax, so the NIT brackets, and you have the IRMA levels. You have 5 different IRMA levels. You have the additional 0.9 of Medicare tax that's buried in there. You have the capital gains from 0, 15, and 20%. So you have these thresholds within the tax bracket where they haven't really raised the marginal rate over like the last 40-ish years. We've been below a top marginal rate of, say, 40% for quite a long time. But if you factor in all those internal spiderweb pieces that I talk about, it's kind of like you're definitely paying higher than that. Then if you're in the 24% bracket, well, you could be into 2 or 3 IRMA levels at that point. So you're not really paying more than a 24% marginal rate, but you're getting less than Social Security because your IRMA premium's so much higher. So here's the key. I mean, at the end of the day, number one, I don't think you should panic. I don't think anybody should panic. I think if you have a plan in place, then that helps you not panic. And this is where I think people should develop strong retirement plans that are stress tested, and stress test it for inflation, stress test it for, market crashes and things like that. And make sure that you have income sources that you can control to kind of help reduce the shortfall that you may or may not have. And I always believe in building a financial plan. And Graham, I know you're the same way. Just building a plan with some margin in it, because I don't think you want to make radical changes in retirement, but you will have to make some marginal changes. So build your plan with a little bit of margin to really just kind of help you feel a little bit better about the decisions that you're going to be making regarding income as you continue to move forward.
Yeah, I think that, like with anything, I was having a conversation with a client not too long ago, and they were, talking about, should my wife delay her Social Security another few months till she hits another year till she hits full retirement age, or should she just take it now? And, based on the situation, it was a difference of it was a small benefit. So a difference of like $30 a month.
Oh, okay.
And, a lot of times for things like that, it's, hey, if $30 a month is going to make a massive difference to your lifestyle, you probably shouldn't be retiring in the first place anyways.
Mm-hmm.
So I totally agree with you, Chris. You don't want to be on super thin margins. You want to know that, okay, my Social Security doesn't keep up with inflation. Heck, even if there were some slight changes to the system, do I have reliable enough income sources? Do I have enough saved? Am I going to be able to fund all the things I want to do? So 100% agree there.
If anything that we're talking about today makes you think, I'd kind of like to talk to these guys, in person or over Zoom, we have a way for you to do that. And that's to get on their calendar for a complimentary discovery session. And let me give you that number, 256-937-2010. You can also text the word visit if you prefer texting. It's that simple too, to get on their calendar. The other thing, check us out at wgfinancialgroup.com. And we thank you so much for spending part of your day with us today, this weekend. This is the Rite Retirement Show. I'm Luann Fulmer here with Cris Wallace and Graham Bauer. So we've been getting into some tough financial truths about retirement. The next hard truth is healthcare. And, we've always talked about this, that retirees may need hundreds of thousands of dollars for out-of-pocket healthcare costs over the course of their retirement. How should people prepare for that reality, Chris?
Well, obviously, my default answer is you need a plan, right? I mean, that's the easy answer. Let's start just with the sheer cost of things. And what's kind of funny to me is I've seen charts online where the federal government says that healthcare has been trending down over the past 5 years or so. But then that's not the case if you ask a federal employee. So if you ask a federal employee what did their percentage of premium increase by last year, it was 11.2%. And that doesn't sound like it's trending down. And I think that, and I'll just stay on the federal minute for I'll stay on the federal employees for a second. As they go into retirement, they're going to have a pension. Most will have, obviously that first pension. And then they're also going to carry FEHB with them into retirement. Well, pretty soon, by the time you're 15 or so years into retirement, that FEHB cost, that health insurance cost, is going to be eating up a lot of the pension that you're currently getting. So the bottom line here is whether you're a federal employee or not, you need to build a retirement plan that takes into account your healthcare cost and what it's inflating at. Because I've seen retirement plans before where they did not inflate healthcare at, we do it double what current cost of living adjustments are. So we have healthcare inflating more than double the normal cost of living. And I've seen retirement plans where they're only factoring in 2.5%, 3% on healthcare. And that's just going to be, in my opinion, it's going to be woefully low. And I think that retirees should build their plan, inflate their healthcare needs, because by the time you get into your 80s, healthcare is going to be a very expensive endeavor for most retirees. The federal government employee has the option to where they can actually suspend their health care. They don't have to drop it. We always tell them federal employees never drop your health care, but you have the ability to suspend it and you can do some shopping around. And we've talked about this on a couple of our federal minutes in the past. But healthcare, I think you need to plan for it. Just looking at the numbers in general, if a retiree were to retire today, this is a non-federal, this is a private sector employee, you're looking at somewhere around probably 202.90 if you're under the Medicare IRMA. So you've got, what is that, 202.90 times 2, that's going to be your Part B cost. So we're looking at 405, almost 406 just in Part B. And if I add an additional $200 for a married couple, so let's say $100 per person to buy a Medicare supplement. So you've got $100 per person there. Now we're up to $605. And if we just throw in an extra $40 for the Part D prescription plan, just the plan itself, now we're up to like $645 a month in terms of healthcare. Now, this is before you start paying for prescription drugs. So I think understanding that cost is important. Now, some of you listening might say, well, that's cheaper than I thought. And I would say, yeah, it probably is a little cheaper than you thought. And actually the coverage of what I just rattled off there, if we're talking about Medicare, a supplement, and a Part D, that's some pretty good coverage. But the problem is it just continues to go up through your retirement and you're on a fixed income and you're receiving Social Security that doesn't have a large percentage of the COLA taken, doesn't have a large healthcare percentage when it comes to calculating the COLA for Social Security. So you end up falling behind. So you got to plan for this. You know, I always tell my clients that I think the healthcare decision at 65 is just as important as your decision on what to do with your retirement assets, how you're going to generate income, you know, how you're going to pull things out tax efficiently. I think that healthcare decision is right up there with all of that because believe it or not, if the healthcare cost is a lot higher, you're having to pull more money. And if you pull more money, you're likely to pay more taxes. So again, just building that into your retirement plan, I think is just huge. And I don't think it can be overlooked. And honestly, I don't think it can be talked about enough as a retiree. I think that's something you have to look at quite a bit when you're retired is, having the ability to change plans and review that. I think you should review your home and auto insurance and change that because you only have so many ways to reduce your expenses in retirement. And while healthcare is going to go up, and it will drastically, you can control it a little bit if you remain healthy and you're able to switch plans.
Well, and the kicker with healthcare, and I think you kind of mentioned this briefly, is that for a lot of people, the 2 times it's going to be most expensive is right at the beginning of retirement and kind of right at the end of retirement. If you're retiring before 65 and you're not a federal or a state employee or you don't work for, there's some private companies that let you stay on the plan, but that's pretty rare. Most people are going to have to get their own health insurance plan for a couple of years. Like let's say you retire at 62, for example.
The bridge, as we call it.
The bridge. I mean, 62 to 65, that's not a huge amount of time, but that is 3 years. And, in Alabama, I believe the limit for ACA subsidies is around $82,000 a year.
Yeah, it's low 80s.
It's in the low 80s. I don't know the exact number, but if you're getting over that modified adjusted gross income, you're going to be very shocked at how high your health insurance premiums are for a plan with very, very high deductibles. It used to be, back in the good old days, 3 years ago, not really the good old days, but just a couple of years ago, we would tell a lot of people if they're retiring at 62, 61, whatever, hey, maybe you don't have to worry quite so much about healthcare because you can probably go on the exchange and pick up some pretty cheap insurance for 3 years.
Right.
With the changes that have come on the ACA, a lot of those subsidies that were kind of those COVID era subsidies have gone away and it's gotten much, much, much more expensive. So what I'm seeing these days for someone living on a not extravagant retirement income, but is over that, whatever it is, $85,000
86,
limit.
560.
86.
Mm-hmm.
For somebody over that, they're looking at a lot of times $1,000 to $3,000 a month for a health insurance plan, depending on what kind of plan they have.
Mm-hmm.
And I wouldn't say the issue, but the trouble with that is you're paying those increased healthcare costs at the time where you also have kind of the greatest sequence risk of withdrawing more out of your portfolio. So you're probably going to have to take even more early on to cover those healthcare costs that you're not going to have forever, but at the most, quote unquote, for lack of a better term, risky time of retirement, you're going to have to spend more than, in that midway through once you're on Medicare. So it is something to be aware of, because if you're planning for, right now my expenses are $4,000 a month. Okay, that's awesome. If you're retiring at 58 or 61, can your plan sustain if for the first 3 to 5 to 7 years you have to spend an extra $2,000 a month on your health insurance? Because that brings you from $5,000 to $7,000 a month. That's a big jump. It's not forever, but it is a big jump. So I do think it's something you really have to look at and compare costs. I mean, people do different things. We have clients that go on, those kind of health sharing type of plans sometimes too. And there's risk in that, but they want to save the money on the premium. So it's not like you have no other options, but that is kind of a key gap to fill early on.
Mm-hmm. You talked about the ACA cliff. The subsidy cliff is kind of what you're referring to there.
Yeah.
Like I said, it's 86,560. But here, there's also a cliff on the bottom side. And for like a married couple of two, it's 21,640. So you have to make in between that subsidy area.
So funny, right? You can be too poor.
You can be too poor. That's exactly right. You can be too poor.
For ACA.
And so with ACA, you have to, we have somebody that we work with at the office, and he's spent some time with us. So we kind of know when somebody should look at it, when they shouldn't, and then we kind of refer out for something like that. But it's really funny the way you said it, Graham. You can be too poor for subsidies, and you can have literally $10 million saved and operate underneath the modified adjusted gross income of 86,560 and pick up subsidies on healthcare. Please make that make sense to me, because it just really doesn't make sense at all.
Yeah, it's very strange, but again, what are you going to do about it other than
abide by the rules, right?
Exactly.
I mean, we can vote and do all those things, but it's. I can tell you the other thing you can do about it. You can build a retirement plan. That's shameless plug right there.
That's the whole point.
Absolutely. So we are getting ready to wind up segment one of the radio show. So I always like to say, if you're catching this portion of the show on the way to church or the way to Home Depot or breakfast or wherever you're going on a Sunday morning, you can hop out to Apple Podcast or Spotify, those platforms, and you can catch the whole show in its entirety. We actually have a lot of people that go out to Apple and Spotify. And actually, we got a few that now go to YouTube as well. So you can hit all three of those platforms and catch our radio show and get the full show, because we're going to talk about some other retirement risk as we continue to move forward with today's show. If you'd like to set up a discovery session, you can do so by calling 256-937-2010. Again, the number is 256-937-2010.
Dreaming up your ideal retirement? It starts with a solid plan tailored to your unique goals. Set aside uncertainty by arranging a friendly, informative session with Cris Wallace. Just text VISIT to 256-937-2010. That's text VISIT to 256-937-2010. Begin charting your course with confidence.
Are you a federal employee feeling pressure from the early retirement offers like VERA, VSIP, or the Deferred Resignation Program? Recent government initiatives have introduced significant changes to federal retirement programs, making employees feel pressured to consider early retirement or face potential layoffs. At WG Financial Group, we help guide federal employees through these uncertain times. Our team understands the complex federal retirement systems and can help you make informed decisions. Call 256-937-2010 to schedule your complimentary discovery session with us today. We'll help you assess your options and create a personalized retirement plan to help you feel more confident. Visit WGFinancialGroup.com or call 256-937-2010 to book your session. Firm is not affiliated with the U.S. government. Investment advisory services offered through AE Wealth Management, LLC, an SEC registered investment advisor.
Would you rather pay more or less in taxes? If you want to pay more, don't do anything. If you want to pay less, talk to Cris Wallace to see what's possible for you. Just text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010.
And we just want to say thank you for spending part of your weekend with us. I'm Luann Fulmer. This is the Rite Retirement Show with Cris Wallace, president of WG Financial Group, and Graham Bauer. Both are certified financial planners and financial advisors at WG Financial Group. You can also head to our website and find out even more about our awesome team there at WGFinancialGroup.com. And if you are just tuning in, we are talking with Cris and Graham about some of the hard financial truths that retirees need to face while they still have time to plan for them. And so, Cris, here's another one, the old 4% rule. I think it's officially outdated. New research suggests 3.7% is the starting withdrawal rate that might be safer for new retirees instead of that 4%. What's your reaction to that?
I think you got to be careful with the 4% rule, because what happens is it floats around. And if you follow Morningstar, which I find to be a very credible third-party resource, that number moves quite a bit. This 3.7 number, I think, was last year. This year, they're saying 3.9. But I can remember a time back in 2013, because I've been in the industry quite a while now, that it was below 3%, probably somewhere around 2.8, 2.9 is what Morningstar said back then. And the reason for that, it has to do with yields. So the stock market has done well in recent history. It's done probably too well in recent history. It kind of sets us up for some overconfidence, in my opinion, but I'll save that for another conversation. But these, the yields off bonds have gone up quite a bit because interest rates have come off zero. And that's really what's changed the Morningstar projections. And through the last 3 to 4 years, it's been significantly higher than what it has been in years past, like I was talking about 2013. But the thing with the 4% rule is it requires you to be dynamic. So let's just talk about that for a few minutes. So let's just say we've got $1 million and Graham and his wife are going to retire, Emma, and they've got $1 million and they're going to retire, and they're just going to pull 4%. So in $1 million, the 4% rule, you can pull $40,000 a year. But let's just say that they were risky with their investments because they didn't do proper planning. They didn't take an assessment of how they were going to pull income, basically no plan at all, because, he's a CFP, but he didn't build his own retirement plan right. And that portfolio now drops 50%. So Graham's payment is going to stay the same, but his balance, because it's down 50%, is actually going to increase his withdrawal rate in terms of percentage. So what started as a 4% withdrawal rate, if his portfolio is now down to half, $500,000 in this case, then now his withdrawal rate is going to be right around 8%. And when you have this scenario happen in retirement, this is where you start to introduce sequence of return. And we've talked about that a number of times on the show. And this is why we think as you're building out your retirement plan, that if you're planning on using what we call rules of thumb, you better make sure that you have a plan in place to kind of validate that that math is actually going to work. You need to take a look at what if we have a lengthy decade like we did from 99 to 2009, where the market is basically flat and maybe slightly negative, how your withdrawal rate is going to impact the longevity of your portfolio. And if you think about that, if you think about the decade that we had from like 99 to 2009, that's basically, in some cases, that's half of someone's retirement, if a retirement is 20 years. If it's like a normal retirement that's like 30 years, that's 1/3 of someone's retirement. And I think when you're considering using this 4% rule that we're talking about, that you need to validate some other things just to make sure that it's actually going to work. We don't like it. I know, Graham, you and I don't like it as a way to plan. In other words, somebody doesn't walk in my office and I do the math and go, okay, you're at 4%. You're good. Talk to you later. Because I think it's a general rule of thumb. I know for me, if someone's coming in and they're, maybe they're at like 5.5 or 6% withdrawal rate, that's too much. Now, you can do that for a short period of time. You can't do that for 30 years. You'll likely run out of money according to the way the studies are done. So again, when you're thinking about this 4% rule, just verify that some other things in the plan are strong, and you're going to need to monitor this on an ongoing basis to make sure you're not getting into any trouble.
And I think the other thing just to mention there is, even if, so in that scenario, you're drawing 4% off $1 million, see a 50% drop in the market, or, slightly lesser drop, 30%, whatever. And you're now drawing 8% off of it. Depending on returns from that point forward, you may not run out of money in your plan, but you're not going to see a lot of long-term return at that point. And I think that can psychologically be a little bit hard for people as well. I mean, we've had a few clients, or I've had a few clients in the last year or two who, have come and said, hey, the market's up like crazy. My balance still kind of seems like it's similar to where it was. And the first thing we look at is, okay, well, what are we taking out? Because if you were leaving it alone and this was still a problem, then we got a returns problem. If you're not leaving it alone and you're drawing off of it, which isn't necessarily a bad thing, just, a lot of people are, that's going to affect it a little bit. So, in one scenario in particular, they're saying, hey, it doesn't really look like there's been much growth in the last 3 years, despite the market being up a lot. It says, well, you've been taking out 9.5 to 10% these last few years, not as regular income, but there have been big ticket items, home renovations, new cars, things like that have led to very, very large withdrawal rates. And two, you're not 100% invested in stock, because most retirees, we got a couple folks that are really aggressive, but most retirees that we work with are not going to be 100% S&P 500. So again, not that is a bad thing to not have quite as much growth long-term and not run out of money. I just think when people see the headlines and, they wonder, oh man, why hasn't my portfolio doubled in 4 years? Well, if you get into a situation where you're just taking a flat withdrawal and, early on you see a drop and now you got to take a higher percentage, it's going to affect that long term, for better or for worse. It's just going to kind of be what happens.
I think people are just better off, Graham, if they just, when you think about income, you just protect the first 10 years of income. I think that makes a lot of sense. Then you don't have to worry about those big drops. Like I was kind of poking fun at you a little bit. Your planning is excellent for a young person for sure. But, a retiree, if their risk, and you can tell this by running Monte Carlo simulations, but if their risk is losing a lot early in retirement, well, just protect that. Just fix it. And you can do that with diversification and making sure we've got a stable source for income. And then you've created a 10-year runway at that point. And that feels better to a lot of people to know, hey, I've got consistent income coming in. I know where it's coming from. I know how much it's going to be. I'm not worried about no silly withdrawal rate. I know exactly the amount of money I've got coming in, and I don't need the rest of my investments for 10 years. Well, good. We got a 10-year runway at that point, and we can relax.
Yeah. I think it brings a lot of peace to know that, okay, market tanks today.
Doesn't matter.
I'm not going to touch that bucket of money for 10 years because I got my income bucket kind of set up for the next 10. So I'm a big proponent of that as well. Just it really does just kind of remove one of those risks. And sometimes I think, to my point of what I was saying a second ago, sometimes retirement can be a little bit more about protecting the risks than just chasing maximum return. And I think people have really, really lost sight of that in the last 4 to 5 years because of how good the market performance is. I mean, it's, I think you've used the analogy, Chris, if it's kind of like when the cop's on the side of the interstate and, COVID was sort of like seeing the cop and
pointing that radar gun at you.
Yeah. And you hit the brakes a little bit. And now as that cop gets further and further and further away, people are kind of increasing that speed and thinking, nothing bad is ever going to happen ever again. I'm not calling for any massive crash or anything. Just saying that the economy goes through cycles. And I think there are definitely people out there that are going to be in for a rude awakening at some point, whenever that is, because of the fact that they got a little overconfident. They didn't protect their retirement as much as they should have, especially if they have an immediate income need from it.
Something to think about, honestly, as you get ready to retire. If I look at the numbers, now I was in my early 20s during the 90s. The 90s was a phenomenal decade. The .com and all of that, and the mid to late 90s was just booming. And you've said before, Graham, and like it's the past 3 years, the market's been up 20+%, and we're double digits this year right now as of today we're recording. I don't know that it can continue like that. And I know that there's this big AI talk and all of that, but let me just remind you that half of America loves AI, half of America hates AI, and only about 20-ish% of people actually trust AI. So it's a very politically divided topic. And I personally believe two things are going to happen to AI, so we can bookmark this as they do, on social media. Number one, I believe that it's going to get more expensive. And the reason I think this is I pay a Netflix bill and I pay a YouTube TV bill. And those things, when they first came out, is like, hey, let's drop cable, jump on these two, and I've got more choices for a lot less money. And now all of a sudden their prices have gone up. Well, the use of AI is also going to get more expensive. Electricity is going to go up. The data centers use water. That's what everybody's really worried about. So the cost of water is going to go up. And therefore, the companies, the corporations, these AI corporations are going to see that the corporations are getting rid of, and I don't think that AI is going to get rid of everybody, by the way, but let's just say that there's some bodies saved or bodies cut, let's put it that way, because of AI. So now the corporation uses less manpower because they're using AI. Well, the AI companies are going to see this and go, oh, we can charge more because they're saving, this much on labor, so we can charge a little bit more because the demand is there, so we can charge. And I think that's what's going to happen. But I don't think AI is going to take off as fast as it probably should. And I am a firm believer in AI because I believe that the world is going that way. And I see it kind of like the Industrial Revolution. I think we want to lead the way, in my opinion. This is my personal opinion. And there's been talk of AI replacing financial advisors. So I'm realizing that our job, some people may use AI instead of talking to us. And if you do, well, that's your risk, because just remember, AI is tuned to basically agree with you in a lot of cases, and it really won't argue with you. It'll tell you how great you are, even if it's lying to you. So just kind of keep that in mind. Where I'm headed with this AI thing, I think we need to lead the world, but that's a whole other conversation. But there are a lot of state and local governments that are going to stop data centers from being built, or at least delay them for a while. So I think it's going to become more expensive. I don't think it's going to take hold as fast as it probably should, in my opinion, again, because of state and local governments saying, I don't want this data center here. And so those are kind of my thoughts there on just, the returns and the markets being really good. At some point, I just don't see the stock market doing 20% for, 5, 6, 7, 8 years in a row. I don't see it.
Yeah. I mean, that would be historically completely unprecedented, really, to see something like that. And, I was talking to somebody at church the other day and thinking back on, if you remember the early days of like Uber and rideshare.
Oh, super cheap.
Where you could, get an Uber for $5 across town. And now it's like, I want to take an Uber from the airport to the hotel in a city, and it's like a 5-mile drive to take 7 minutes, and it costs $30 with a tip. And so I think a lot of people do forget that, these, not to get on a huge tangent here, but these types of technology, really what's happening right now is every company is just trying to get market share. And once somebody does and, gets quote unquote victorious, whether that's OpenAI or Google or Anthropic or whatever, it's not going to be as cheap as it is today. And I think that we can't just ride the wave of just the hope of future earnings. And I mean, there are good earnings today too, but the hope of future growth forever. And so again, like I said, it's not us calling for, oh my gosh, the market's going to crash tomorrow, pull all your money out. That's not what we're saying at all. I'm just saying that I've met so many people who are going to retire pretty soon or are recently retired, and they look at their 401k that they were completely invested in the stock market in for the last 30 years, and they think, well, that did really well, especially the last 5. I'm just going to keep doing that forever. And for some people, maybe that's okay, but you're taking on a lot more risk than I think you realize in doing that. And, unfortunately, I just do think next time we see some kind of correction, it's going to wake some people up in a way that they probably haven't been in a while.
Yeah, I think too, just go pull up a market chart and just look at like the last 100 years and look at just the flat periods, because those things happen. And I think when you're a retiree and you're considering retirement, you got to think about what if that happens, because the vast majority of us listening to the show today, including myself, you really only get one chance to do retirement right. If you're in your 60s and you decide to retire and then decide, hey, I need to go back to work. Well, we know that we're not supposed to discriminate when it comes to age-based hiring. But what are the chances of you getting a job at like 63? It's not quite as likely as it was when you were in your 20s. So just go pull up like the chart and look from like 1929 to 1943. It's a pretty flat period. 1966 to 1982, pretty flat. I talked about like 99 to 2009 timeframe, pretty flat. What if that happens during the first part of your retirement when you're trying to spend as much money as you can to have as much fun as you can while you're as mobile as you can be? And I think those are the things that we need to think about when we're retiring. And that's why I just think when we talk about these rules of thumb and relying on outdated rules of thumb, I just don't know that it makes sense. And I think anybody can publish, and no disrespect to Morningstar, but anybody can publish an article and say, well, guess what? The new withdrawal rate is now 4%. Well, now 3.9. Now it's 3.7. Right. Guys, just build a plan.
Yes.
Just build a plan, understand what your expenses are, inflate properly, inflate healthcare properly, figure out a withdrawal strategy, do it as tax efficiently as possible, set up your estate planning, make sure all your assets go to your heirs the way you want them to, and as tax efficiently as possible. That's what we do at the office all day long. Like we just look at all of that and we just kind of ignore these rules of thumb.
Mm-hmm. Yeah. Build a customized strategy. And I love that.
For sure.
You build it for the person or the couple that you're working with. So to do just that, you can go in for a discovery session, guys. It's complimentary. And that's what we're urging you to do today. Get some of your own personalized questions answered. Just call 256-937-2010. You can call. You can also text the word visit. If you prefer texting, it's that simple. Get on their calendar, and you're listening to the Rite Retirement Show. I'm Luann Fulmer, here with Cris Wallace and Graham Bauer. Guys, here's something interesting that really fits right here. According to some recent reports, confidence in retirement savings lasting longer has jumped from 41% to 71% for those people who actually work with a financial professional. So why do you think it can make a difference?
I think that the biggest thing that makes a difference is just seeing all the numbers laid out and actually knowing that you have a strategy that is data backed, that's been tested, and that you can feel confident in. Because for a lot of people, they're just thinking about, hey, my expenses are maybe this, and my Social Security will be around this, and I'll maybe take 4%, and they're using the rules of thumb. And, that's a good starting place to kind of get an idea of, are you anywhere near ready? But that doesn't tell you, well, what happens if returns are not as great as I thought? What happens if there's a downturn early on in retirement? What happens if either me or my spouse doesn't live as long as we thought we would, or one of us or both of us live much longer than we thought we would? There are so many different scenarios that can happen. And I think you just want to be prepared and know that you've seen what that looks like. Obviously, you can't prepare for everything. We've had people ask us to run. The scenario that was the most extreme that I've ever been asked to run was, what if the government cuts my federal pension completely? They cut Social Security and they cut all my VA benefits. I was like, okay, well, they would probably have to have kind of a personal vendetta against you to do all of that. We can run those scenarios. I don't know that you can fully prepare for a scenario that drastic, or, what happens if the dollar drops to zero in value and everyone
We're all in trouble.
barters on gold. I can't really model that for you, but I don't think anybody can. But those scenarios that have been historically more likely, like inflationary periods, lesser market returns, changes in, lifespan, things like that, that there are trends and there are actual ways to kind of model that. We look at all of that so that when somebody is getting ready to retire or they're early on in retirement, they can have the confidence to say, no, we've looked at those numbers and we feel confident that even if that happens, we have a plan, we have a strategy, and we're not going to have to, go back to work or start eating cat food.
Yeah, I think, Graham, when we talk about just the difference a financial professional can make when it comes to just working with somebody in retirement, one of the things that I guess, learned early on, I kind of look at it like it's no, then yes. So early in life, sometimes you have to be able to tell yourself no. Like, in other words, maybe I want to buy this new car. No, I shouldn't do that because I need to save and fund my retirement. No, I shouldn't do this because I need to put this money away for my emergency fund. But when you get to retirement, you should have a plan that will give you the ability to tell yourself yes. Because I think what happens with retirees is you've told yourself no, 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 no all your life. And then you get into retirement and it's like, no, 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 I can't spend my money. But working with a professional and having that confidence in yourself to be able to spend that money, I think you gain a little bit of that confidence by working with a financial professional, somebody that can help you say yes. And I would find somebody that is not, because I know people in the industry like this, because I have friends, they're just kind of fear-driven. And they tend to push their bias onto you as opposed to looking at the data. And sure, things can blow up and not work out the way that maybe you want them to, but that's why you build a plan. You build a plan to try to mitigate those big fears that you have so that you can turn around and actually spend your money. So I like to say it's no early on in life, and then yes, because sometimes people have to give themselves permission to actually spend money in retirement. And again, I think that's where working with a professional, whether it's us or somebody else, just find somebody that can give you that confidence that your retirement savings is going to last and also help you give yourself permission to say yes in retirement.
So, Chris, so many people spend their entire working lives looking forward to retirement as a time when things are going to finally get simpler, and they don't even think about taxes. So when I bring this up, that for many retirees, taxes often get more complicated and can actually go up after they stop working. It's kind of hard for everybody to believe. So tell us about this. Chris, why are so many retirees blindsided by a tax bill that they never saw coming and never planned for?
I was talking about it earlier. I said, I think it was in segment 1, where I was talking about the IRS spiderweb that they have. So we have the marginal rates, and buried within that marginal rate is the net investment income tax, the Medicare tax, and then also the IRMA tax. And I think when it comes to a retiree, I think the thing that surprises them most is the Medicare IRMA premiums that go up, because the Medicare IRMA premiums go up, and that's pulled out of your Social Security if you're collecting Social Security. So you're getting less Social Security income. To me, that's a tax, right? It really is. We call it the IRMA penalty, but at the end of the day, it's because you made too much money and you crossed certain thresholds for adjusted gross income and caused your IRMA premiums to increase. So you actually incurred tax. You don't have to worry about that while you're working. So in that sense, your tax bill could actually go up when you're talking about adding IRMA in there and calling it a tax. I think what Congress is really good at is they're really good at calling things different names, because I look at IRMA as a tax because you made over a certain threshold, you're going to pay more in Medicare premium, and that's a tax to me. For a retiree, if you're in that low 24% marginal rate as a pre-retiree, but then you retire, well, if you're in that 24 bracket in retirement, you're going to be right there at that first IRMA threshold. So you may not pay any more marginal tax, but you may pay a higher Medicare premium as well. And I think, again, those types of things surprise people. That's probably the biggest surprise, honestly, Luann, that I think people run into. They sell a piece of property, they have some capital gains, and then next thing they know, they're paying a year's worth of IRMA premiums. But if they do that in 2026, they really don't have to worry about it until 2028, like 2 years down the road, because Medicare is going to look back on the 2026 tax return. And so by the time you sell that property, let's say you sold it in 2026, by the time 2028 gets here, you pretty much forgot you did that property sale in 2026. The next thing you know, you get a letter from Medicare telling you, oh, by the way, your new Medicare premium for the next year is X because you made too much money. And you're like, wait a minute, I haven't made any money. Oh, wait, I sold that piece of property.
Are you kidding me? That's terrible.
Yeah, it happens. It happens all the time. So a lot of times when we're working with business owners trying to unwind a business or people trying to sell property and things like that, there are strategies that we can kind of talk about and say, are you open to looking at these kinds of ideas to try to help keep your taxes at a manageable rate? Sometimes it's, Roth conversions more aggressively. Sometimes it's like, hey, maybe we need to get a little bit more aggressive on the conversion, go ahead and eat a couple of IRMA brackets for a few years, and then we're kind of done after that. Because again, this stuff can just really, really surprise you. And there's no guarantee that the IRMA premium increases aren't going to continue to increase. And they will, because they have throughout history since they've been enacted. So, and then there's no, guarantee that the tax rates are going to stay the same. I know that they're permanent, but, like we always say on the show, and everybody out there knows this, they're not. And then another congressional party could come in and actually, change the tax law and vote it into law at that point. So I think as a retiree, number one, I think you got a plan. I think definitely building out a plan that takes into account future taxation. Now, those that have been listening to the show for quite a while, they know I'm not like a Chicken Little sky's falling kind of person, or I'm not a negative Nelly, and I don't think the top marginal rate's going to go back to 90%. But I think it's pretty likely that tax rates could revert back to somewhere close to what it was like in 2013 when President Obama was in office. Now we're in some of the lowest in history, but we're talking about them just raising the top marginal rate 2 or 3% and shifting the other brackets up. I mean, like I said, Congress is really good at not really jacking the rates up, but making the inner workings of that spider web pretty sticky internally so that when you start going through certain levels of income, your tax don't really change, but the payments that you make are changing, like the IRMA we were talking about.
Yeah.
Congress is really good at just kind of mixing names. But at the end of the day, I think as a retiree, you have to plan for taxes being a little bit higher in retirement, not crazy high. And I think you should do all you can today as you're building up to retirement to diversify your buckets of taxable money that you have. So you have Roth, that's tax-free. Everybody knows that. We have traditional and pre-taxed, which we haven't paid taxes on. We'll pay taxes or subject to taxes when we withdraw it. And then we've got like after-tax brokerage accounts, which is like capital gains money, 0, 15, and 20%. And then you also have HSAs. So, it helps to know, it helps for people that come in the office to know that you're doing a lot of what you're telling them to do. And I think that's what makes us stand out and really be different. So if you'd like to set up a discovery session with us, all you got to do is call 256-937-2010. You can give us a call at 256-937-2010. I can't believe I could remember the number there, Luann. 256-937-2010. I hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
Please remember, converting an employer plan account to a Roth IRA is a taxable event. An increase in taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Graham Bauer holds the enrolled agent designation, but is not currently offering tax preparation services. Neither the firm nor its agents may give tax advice. Individuals should consult with a qualified professional for guidance before making any purchasing decisions.
Investment advisory services made available through AE Wealth Management LLC, AEWM. AEWM and WG Financial Group are not affiliated companies. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Financial Group are not affiliated companies. companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. WG Financial is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial. This radio show is a paid placement.